Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to the program. We're here to talk about a variety of topics this week. I'm here with Jeff Perry, Brian Regan, Russ Ball, all of us. I'm Chris Boyd, all of us from the AMR team at Wealth Enhancement, and glad to have you joining us for this show. I'm looking at the wrong camera all this time. Glad you're here. If you don't watch, you can listen on Spotify and Apple, but you also, or anywhere else you like to listen to podcasts, or you can catch us on YouTube or on our website, and you can find that easily by going to somethingmorewithchrisboyd.com. All right. With that being said, we are going to talk about in the news this week, lots of topics affecting investors and considerations. Probably one big one that's been on people's minds for the last 40 some odd days is the government shutdown. Jeff, this was probably going to be resolved by the time this looks like it's pretty much close to being resolved today, but
it is resolved. Yeah. The president signed the bill that passed the House last night. And so the government shutdown is officially over. It's going to take a few days, of course, to get 600,000 federal employees back to work and, all systems. I think most people are thinking about food benefits and airlines based upon the news cycle. But I'd say within a week, things will be back to normal, quote unquote, for our federal government. And, politically, it's a win for the Republicans. They held their ground, and all they gave up was a promise that they would discuss the ACA tax credits by the second week in December. And for the American people, it's probably a loss that we had to go through it.
Yeah, I was going to go to that same topic about winners and losers in this process.
Mhm.
The compromise, looks like the Democrats kind of blinked in the game of chicken. Well, on the other hand, someone could say they were acting responsibility in the face of escalating economic and holiday travel, kind of issues that seemed to be looming. I did hear they got one concession that I haven't heard too much talked about, this government accountability office getting a little more reinforcement of its resources that had started to be a little more gutted previously. I don't know if that is really going to have significant impact, but the ability for suing the administration over potential violations from time to time that have been identified.
Yeah.
Do you make anything of that, or think that's
no? That was part of a broader deal that was part of this. That all of the previously laid off federal employees, would be called back. So I don't know. It's a lot of, in the words of our esteemed guest here, a lot of nonsense, a lot of bologna sauce here.
Yeah,
it's nonsense, bologna sauce.
It's not necessary. I can point fingers wherever we want to point fingers, but the CR should have been approved. It wasn't the place for this, but the country does need to have a debate about how they want to handle the Obama era tax credits for the low income people primarily, and their health insurance. And, that we all knew that bill was expensive. The tax credits hit it for a long time. So now the country has to figure out long term what we're going to do with this problem.
Yeah. So this still remains looming. All we got is the potential for a vote. Sounds like the House is even unlikely to bring it up for a vote. So that leaves us with sort of a challenge. On the other hand, the president's talking about, we should have a dividend, a tariff dividend, a Trump dividend. I think the president likes the idea of people getting money on a check signed by him, and the stimulus that presumably would provide. I think in the face of the kind of debt load we face, I don't know that that's a needed stimulus per se, but in any
Well, that was in the context of the tax credits for the ACA, the Obamacare, that the president thought it was a better idea, and it's arguable that every person who pays for health insurance is facing escalating premiums,
premiums, no question.
and so
Healthcare is ridiculously expensive. It's insane.
and so that as a subsidy to all Americans, that a check would go out for $2,000 from the revenue from the tariffs. I'm concerned that we're saying the revenue from the tariffs a little too much. It's like,
yeah, we don't know we're going to have them.
Somebody who gets a windfall and says, I'm going to use it for this, that, and the other thing, and you add it all up and it's more than the windfall. And then the question of whether or not we have to pay back the tariffs, as we discussed in an earlier episode of the show.
Yeah.
So, it's an opportunity. So, like, we had an opportunity to do some reforms in the big, beautiful bill, and we got some reforms done to it, the tax code. This is an opportunity to really dig in, bipartisan, and decide what is in the best interest of our citizens and our national debt and all the factors about healthcare for low-income individuals. And so we have an opportunity to do it right, fix Obamacare, scrap Obamacare. However, whatever the best solution is, it's an opportunity to have that debate. And so let's hope they have it and they just don't make some petty arguments and do nothing, kicking the can down the road and people losing their health insurance or creating a bigger national debt, by just giving away free stuff to everybody.
Yeah, I feel like, it is hard to imagine that all of a sudden, this constant fighting between both sides is going to stop, and they're going to come to the realization that actually this might help everyone if we can come to some agreement. I mean, I know that some Democrats, caved according to their, Democrat colleagues in this most recent experience with the shutdown, but I don't know that that's a sign that there's a lot more, bipartisan agreement to come. Hopefully it is, like you said, but I don't know. I don't really have a ton of confidence.
Well, I'm not saying I have confidence either, Russ. I'm saying it's an opportunity. So the Republicans are still in the majority, and they have an opportunity. If you go back to the debate, for the presidential debate, there was a very pointed question to President or candidate Trump at the time about his healthcare plan, and he said he didn't have one. He wasn't president yet, but he had the foundation of a plan. And so it's an opportunity to put this forward. He's a bold leader. He's got big ideas, and this is a problem that the country's facing. So it's almost a challenge for him and the Republicans. Can they put together a proposal that is agreeable to the Democrats, because they're going to need a few Democrat votes to deal with this ongoing and looming problem? It's probably one of the biggest fundamental budget problems that the country has, is how do you provide health care to people who can't afford it, and how do you keep the premiums from everyday working Americans in a reasonable rate? And so I'm optimistic, Russ.
Okay.
All right. With that, let's go on to another topic, and let's talk about the 50-year mortgage. And Russ, do you want to elaborate on how did this come up? What do you hear how this came into the news recently?
I've heard it in the news. I don't know how it got started. I don't know the backstory myself.
So, Brian, do you know how did this call come into the news?
Sure. So, housing affordability is a problem. As mortgage rates have doubled, and so prices for homes have doubled as well. So, the average age of a first-time home buyer right now is 40 years old. I think people are looking for solutions, and Bill Pulte, who works in the Trump administration, suggested that this might be an option, something worth looking at. And if you're wondering, why does the government have control over this? Well, the government still controls the GSEs, which guarantees the payments for the bondholders of these mortgages. So they very much have the ability to make this a possibility. And the idea was floated as a way for people to get into houses on a lower monthly mortgage payment.
I have to say, the idea of a 50-year mortgage becomes really challenging and perhaps unappealing. I guess your point is a good one, that if it helps people to get into home ownership, that it can have virtue, because over time equity tends to increase, and home ownership is certainly one of the things that we strive for as a way to grow wealth over time. But the amount of interest that would go into a 50-year mortgage just sounds staggering to me. I do recognize, though, that most people don't actually keep a mortgage for the term of its length. So maybe it's less to be focused on the extreme amount of interest cost. Jeff, you look like you're looking to comment as well. Brian, I know you have opinions about this, so I'll come to you next. But Jeff?
Yeah, no. so yeah, what Brian said is correct, factually correct. It's just, I'm just afraid that too many people are gonna just go for the low payment without, the deeper financial considerations.
And does that reemerge some of the challenges that when you don't have enough skin in the game, there can be problems that emerge? We've seen that in the financial crisis.
Yeah, certainly. If we're in a period of appreciation of real estate, as you indicated, it usually happens, but we know it doesn't always happen. Then
Right.
some of that goes away because people are building equity, and if you have equity into real estate, you're going to take better care of it, and you're not going to walk away from it.
Right.
But it just scares me that people would, take these products to get into a home, just like, no down payment, no.
Well, a 30-year mortgage, you end up having what, like 3 times the principal in interest,
Yeah.
3 times the principal in what is the, I forgot now. I think it's at least double the amount of cost in interest that you pay in principal structured loan.
Yeah, you have it for double the amount of time. So that certainly makes sense. I also wonder, we haven't gotten into the weeds of this and how banks would look at this, but you have to think that the interest rate would be higher.
Right.
Yeah. I would think so.
Generally, the longer
risk,
the payback period is, the higher the rate, because the bank's taking interest rate risk. So, when you add all those things up, I just think it's a bad idea.
So maybe not a first preference, but Brian, I get the impression that you think there's virtue to the access to such a loan structure.
I don't think it's a bad idea. I think it's a fine option. I don't know if I would personally take it myself. I'd have to evaluate it on the merits. I have 30-year mortgages. I don't have a 15, but a 15 is an option. All the arguments against the 50 would apply to the 30-15 argument. If you have a 15, you pay down, your equity quicker too.
Yeah.
So
what we're used to versus what could be. Yeah.
So if you're against this, I think you'd have to be a proponent of a 15 over a 30 too, because to me the arguments are all the same.
Let's ask Russ a little bit though. You're probably the person amongst us who's most impacted by whether it would enable you to access home ownership. What's your take on this?
Yeah, I mean, I think, speaking for myself and a lot of people in my, age group and my friends, we all aspire to be homeowners. So I think anything that will make that more feasible, even if it's taking on a 50-year mortgage and then, like you guys said, most likely not keeping it for 50 years, and paying down more as your wealth grows, and I think that would be an option. I think right now there's just such and Brian has spoken on this in the past, there's such a feeling of hopelessness when it comes to home ownership specifically.
Right.
Among your peers,
among my peers.
Yeah.
And just, it feels like so far out of reach, especially in certain geographic areas. So pretty much anything that's going to make that more possible, I think is going to be jumped on as not by everyone, but by some people.
Appeal for the accessibility.
For me, let's look at it the merits, right? Like, so this is the positive take. Russ rents right now. His landlord at the end of his lease could decide to increase his rent by 10%. Russ either has to move, which comes with a bunch of expenses, or pay the extra 10%. Now, if he gets a 50-year mortgage, even if he's not paying down a whole bunch of principal, which he's still going to be paying down some, at least he knows what his payment's going to be roughly, unless his taxes change significantly. So it's almost like a fixed rate rental, even though he is building some equity. The average person lives in their house, let's say 10 to 12 years. The average mortgage lasts around 5 to 6 years. If you have a 50-year mortgage, it might financially be of your interest to stay in it for 15 to 20 years, right? But if the alternative is renting, then it's probably a better alternative. You at least have locked in your living expense costs. Of course, there's maintenance. Of course, taxes could change. But, you are building some equity, and you do have a little bit more assurance on where you're going to live and how much you're going to pay. Of course, your maneuverability is less. You are stuck there for 15 to 20 years. I think there are pros and cons to this. And that's why I say, like, I'm not for writing it off. I think it's a fine option, and it might be a good option for a lot of people. I think it's a reasonable question about whether it will actually make home affordability better. And I think the answer is no. I think if you give people a cheaper monthly option, all you're going to do is drive up housing prices. What we really need in this country is more houses. We need to remove the red tape to build more houses. I live in Boston, but I'll tell you what, in the greater Boston area, there's very few new houses going up. Okay, that is just a fact. Every house is 100 years old. In Florida, where Jeff is, where Chris has a home, there's new houses going up all the time, right? Or at least when the cycle is favorable. So that's the crux of why certain places are more expensive than others. I mean, you could come up with these financing tricks all day long. But it's just going to be a Band-Aid on an axe wound. So I wish everybody would concentrate on what really needs to change to embrace some building in the places that need more buildings.
Well, I got to say, I entered this conversation on the 50-year saying, hell no, But I guess you guys made some good arguments. I'm a little more open to the prospects of how it could be utilized, and that it could allow people greater access. I do wonder what impact that has on prices, though. If there's more people in the market able to purchase, does that have some adverse, for the buyers, try to drive prices higher again? But not as a homeowner, that's of course welcome. But as a buyer, that's may create additional challenge. In any event, let's move on to another topic. Good discussion on that. Brian, you brought up this issue of Kyle Busch and indexed universal life insurance lawsuit going on. Can you give us a little bit of what's going on with that?
Yeah, I'm not an expert on the subject. I recently just heard about it myself. But what it sounds like is the Busch families were misled into buying a very bad annuity. And I wish this was not commonplace, but it seems like it is. And I wonder if you guys would agree with me, but I just wish people would stay away from annuities in general. Here's the promise of annuities, right? For the most part. And Chris, you're the expert on this. So correct me where I'm wrong, but you pay premiums, usually a big upfront premium, and you'll get an income stream at some point in the future that is typically guaranteed, for a certain rate. That would be like a fixed rate annuity. A variable rate annuity is you pay a premium, it grows based on the underlying investments, and then you get an income stream when you turn on the annuity. But it usually comes with a lot of fees for that guarantee, and the fees can be so onerous that it seems like highway robbery. And oftentimes the commission structure that exists makes it so the people selling you the annuity are, let's say, incentivized to give you a raw deal. So, I think you can create the portfolio on your own. You could create an income stream on your own. We could do it for you if you want. And B, I question the ethics in this industry.
So a lot to unpack. I think in this particular case, it was a life insurance policy that was involved. But to talk about the annuity comment you made, I think there's so many complexities as to the different kinds of annuities and the different cost structures embedded in them. It can be overwhelming. And in broad stroke, there are broadly two different types of annuities. There's deferred annuities and there's immediate annuities. A deferred annuity is one where I put my money in, I let it accumulate, and then I can take my money out later on. An immediate annuity instead is one where I say, here's my money, I'll trade you this for an income stream. Okay. And when it comes to deferred annuities or immediate annuities, there can be two types. I feel like that Instagram. Well, there's two things. Have you seen that one where it's like there's good news and there's bad news? Anyway, so there's two types of annuities, really. There's variable and fixed. And within the fixed category, variable is like funds, a lot like your mutual funds of sorts. There's market risk. But a lot of times there'll be a feature, a cost paying feature, where you can get some guarantees associated with it. In a fixed annuity, there can be an interest rate like a CD, or there can be some kind of a market related investment, but it's not fully invested in the market. It's some participation, but some limited downside exposure. And all this sounds good, but it's very complex and there's a lot of costs built inside of these. Now, in this particular instance with the Busch family, they were sold an insurance policy. This is an indexed universal life policy. So again, that notion of you can get some participation in the market, but not the downside risks of market decline. So it's not true participation in the market. And what your performance will be is very ambiguous. You don't know going into this what's really involved. This product apparently was sold on the basis that you'll have tax-free income on the back end when you want to take money out. This is often the way life insurance is sold as an investment. Life insurance is death benefit protection, first and foremost. It is purchased with the intent of I have a need or a desire to produce wealth if I'm not around to do it. Okay. Or maybe I have an estate tax, or I have a particular reason I need liquidity and wealth to be created. Now, in the case when it's used for an investment, keep in mind there's a cost component. That's the insurance. But I do get a tax deferral for the cash value in there, a lot like an annuity, as you were describing, Brian. In this case, it's this ambiguous, what's my rate of return going to be? And it could be very modest, as it turns out, because of how I participate. Essentially, internally, the product is using options or futures as the way to get you some element of market participation while mitigating your downside risk. We can do that in other ways, right, Brian? There's lots of products, there's lots of services that don't require a massive a massive deferred contingent sales charge. Back-end load, if you prefer. You don't have to have these big costs associated with these products to get some of those features. So in any case, in this product, the issue was they were sold this notion of tax-free retirement plan, which is really a misnomer. What's happening is we're borrowing from the cash value that we hope will accumulate, and not paying a tax because it's a loan. But there is cost for that loan. And if the money's borrowed out, if the fund isn't the embedded expense of the embedded values, cash values of the policy aren't sufficient to sustain the policy, it's a universal life structure. If we take too much out, the policy falls apart, and then the taxes are due anyway. So it's a challenging structure. The argument was they were made false promises for guarantees.
Well, I think a big part of this case is the illustration that the agent used when making the presentation to the Busch family about, projected amounts of money that will be in the policy and available, in addition to the tax-free part. But the illustration, like, this is going to be worth this year, next year, and so forth.
This accumulated cash accumulation, this value that presumed to be able to accumulate, which is not necessarily known because it's not a guaranteed number.
That's right. And if you read some of the news reports, if the allegation is, in a period of a generally up market, the illustrations are now $8.5 million below the value of the policy is $8.5 million below where the illustration was at whatever given time period it was.
Yeah.
And that the fees were not properly disclosed. Fees are always a big part of these lawsuits that happen. And I think the lesson, for all of us is know what you're buying. Like, really understand.
Number one lesson, know what you're buying.
Know what you're buying. Know, how many times have we've said this on this podcast, but, ask, is the person a fiduciary? Are they acting in your best interest, or are they selling you a product? Ask, how much is the person selling you, in this case, or working for you, being compensated?
Right.
And how is that compensation coming? If it's simple and easy, that someone should be able to explain it in a minute.
And number two, if it sounds too good to be true, right?
Yeah,
I mean, you don't get something for nothing, right?
That's right.
It's just the reality of this. And we all want that. I want fabulous returns with no risk, but that's just not the way reality things work. There's a big cost if I am paying for risk mitigation the way we tend to want this. It can be done, but it comes at a cost, and that ultimately affects either performance or access, or there's a whole variety of aspects of how you pay that cost.
Right.
So did you want to comment?
Yeah, I mean, that was exactly what I was thinking. If it sounds too good to be true, I mean, I've heard the pitch myself on universal index life insurance. I'm sure there are use cases out there, but in general, it's sold as something that you have the insurance on the one side, your investments are growing on the other, that you could borrow from it tax-free. It sounds great if you don't know all the details of what goes into something like that. But I think
the other challenge of these products as compared to say a variable product is it's not transparent for cost.
Mm-hmm.
If I have a product sold by prospectus, at least I know everything has to be detailed. It might be, pages within the tissue paper prospectus, but there's clarity. I can find out what are the costs embedded and how do those accumulate. I can get a better sense of that. And if I don't have to tell you how much I'm charging you, do you think I'm charging more or less than the product I have to tell you how much I'm charging you? I think it's clear you're going to be paying more for these kind of products when it's less transparency.
This is a perfect example. So all that is true. In addition to that, it's a perfect example of why working with a financial advisor who's a fiduciary. And if you are interested in a product like this, you can talk to your advisor who's not being compensated to sell you this product.
Right.
In this case, it sounds like that the only person or company that the Bushes were relying on was the sales people.
Right.
And that, they were lied to. That's the allegation. But if you're working with somebody, get us, before you make a big financial decision like this, talk to a trusted advisor, that doesn't have a stake in the sale of this product, and get their opinion about it, and
Yeah, and
discuss options for the same goals.
if you have a Pacific Life indexed universal life insurance policy, it doesn't mean you necessarily have been swindled or anything.
Correct.
But it's probably worth having a conversation with someone who's a disinterested party to say, does this make sense? Where do I stand? I gather there was another big lawsuit finding with similar, Pacific Life index universal life product. That's a mouthful just to say, right?
Yeah.
And there was a big jury verdict in that as well. So in any case, buyer beware when it comes to some of these things, and get some good help in the process. Hey, let's end on a fun note instead of some of this doom and gloom. And let's bring in, we've got some students joining us today. And guys, welcome to the show. And we want to give you a chance to introduce yourself to our audience. Tell us your names and what brings you here today.
My name's Roy Glenn. I'm a senior at Mashpee High School. And in our curriculum, we have a school to career class in which the teacher kind of focuses on informing everyone on how to go about knowing what you want to do in the future and making sure you have a plan, because you can really do what you want, but you just need a plan. That was kind of the main goal of it. And we were both interested in finance, so we came and reached out to Wealth Enhancement about job shadowing, just seeing about how the day-to-day job goes, what they work on, the clientele, kind of the step-by-step process of being an advisor. And we're here just listening in on the podcast.
All right.
And I'm Michael Valois, and again, I'm a senior at Mashpee High School, and we're a part of the school to career class. And again, it's just all about career readiness and learning about what you're getting into. What's the best path for you? Is it college? Are you going into the trades? But whatever it is you want to do, it is best to, again, have a plan, know what you're getting into, and just be confident. Having confidence in going into whatever path you want to do is very important. And, this class does a great job at getting us ready, getting a feel for what the professional world's going to be like. And obviously we set ourselves up with these opportunities, and we have great sponsors that let us come in and get a feel for our preferred industry. And that's why we're here today. We're looking to learn more about the financial field.
And we started off asking you guys right out of the gate, what's some good financial advice you think your peers would benefit from? Michael, you were saying a little bit about planning.
I would like to touch on planning. I think it is very important for kids my age to just have a general idea of putting money aside, because a lot of people like to get their paychecks and then spend them very quickly. Just having an idea of what can I spend? What should I be putting aside? Because, you get right out of high school and you're hit with college. You have to deal with housing. You have to, what car are you going to drive? How am I going to pay for insurance? All these things. And when you're in high school, all you're thinking about is, can I go out to eat with my friends? What clothes can I buy? And that's really where you have to have a conversation with someone who knows what they're talking about, or you can inform yourself. How can I put money aside? How can I save for my future? And it's something that a lot of kids, I feel, don't really get prepared for. And that is a big problem today.
Yeah. Roy, what do you think? You got any suggestions for your peers?
I just wanted to touch on the same stuff. In high school, you're still living with your parents. You don't have to focus on those criteria on the insurance or food, really, like for your house. Or some people don't pay for their gas, electricity, stuff like that. So in high school, a lot of people, they're working 2-3 times a week during the school year. They're working all the summer, and they just spend it on what they want to do, what they have fun. I know people that they didn't save before college. So summer before senior year, they're working 2-3 jobs, getting as much as they can possibly get, or they didn't even have enough going into college. Some people might take student loans and not really think about any consequences from that. So just knowing what you're doing, and if you guys had any advice as well, what the best process would be for just the average person, 4 years of college, parents, family income, average, what do you think the best steps to go about that? And just
we've done many shows on the topic. Jeff has been talking about this quite a bit over the last year or two when it comes to college readiness and the finances of that. It's a very challenging process. Brian's, as soon as his kids have been born, he's like at the outset doing savings right out of the gate, right, Brian? You're focused on the potential costs of college education. Your point is a good one. It takes preparation and maybe many years of savings. And when you're thinking about these decisions, you hit on it pretty well when we talked off air. The idea that you got to look at net. What's your resources you're going to have going into it? What kind of help? If you get merit aid or some manner of benefit from the school, or what's the net cost out of the experience? Jeff, you're probably the person to talk to this topic better than anybody.
Yeah, these two young men are pretty impressive. We were talking offline, and they both are thinking about those things. They're going to make their college decision based upon the school that they want to go, but also the school that they can afford. At the end of the day, you don't want to come out of college by ignoring. You don't want to spend 4 years in college ignoring all the finances of college. You don't want to come out with a mortgage, basically, paying off student loans for the next 30 years. So think about debt, think about responsibly building your credit, think about living within your means, and thinking about doing work study or working over the summer. You guys are right on target with, I think you get a couple of future employees here, Chris.
Yeah, we got the possibilities, huh? All right.
Yeah, they got a good foundation.
The future is strong. Let's hear it for Rory and Michael. All right, with that, we're going to end our show. Thanks, everyone, for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.